So, having said that, if you have a few spare minutes, feel free to join. There might be some fun stories, maybe not so fun, maybe more serious, maybe less. But feel free to join anyway. And yeah, I think it's hard to make people talk less loud, right? No worries. So, glad to be here today in Brussels. Glad to see everyone on a Saturday, which is not a business day, but people still put their time and efforts to come here and maybe learn something new. And that's always great. So since it's the first time I am speaking at Stable Summit, I'll just give a brief intro about who I am and what I do and what I love and what I don't. So I'm a co-founder of Resolv Labs. I graduated as an applied physicist, but went into finance and worked for 12 years there. And yeah, it's a little bit loud now here, but what can I do with that? Whatever. So I worked in TradFi for quite a while, for more than 12 years, doing derivatives, structured products, complex solutions, hedging large corporates. Oh, now I've lost my deck. And at some point in time, I shifted full-time into crypto from TradFi, so I'm kind of a ex-TradFi guy, and that's how I look at things. Wanted to catch your attention with a brief of an interesting intro, and I'll start with the fact that I have a full hour to talk about stuff. So, I'm an ex-TradFi guy building a delta-neutral stablecoin. The style that I want to have today, within like almost an hour of conversation, is a bit more conversational to make it a bit more fun and a little bit less formal. And the level of complexity of this material, well, you know, when you have a conversation, you can talk to people and adjust what you're talking about, make it more in-depth or make it more simple. That's not the case here, I think, so I'll just pick something in between. So the complexity will be 2.5 out of 5 potential level of complexity in this discussion. And I'll start with a fun fact. It is that some time ago, actually 3 months ago, Deutsche Bank conducted a full-blown survey of 3,500 people in the European Union, UK, and the US, and asked a simple question. Looking at stablecoins, you think they will be disappearing or they will still be around? So do you think stablecoins will survive or do you think stablecoins will die? That's the question that was asked. And I myself was surprised, maybe you are not surprised, but I am, that 42% of people said that stablecoins will not survive. They will be disappearing. Strange, right? Only 18% of people on the streets said the stable coins will still be around. That's a bit weird for us who gathered today on this rainy Saturday to know more about it, but that's how the public perceives this. And there is actually an interesting point on this, that generally stable coins failed in some way to be a usable instrument, and there is not enough confidence in general in how stablecoins work and if they actually provide value. And basically, we'll have a look at that in more detail. And how I'll take a look at this is basically start with some formal stuff like the definitions of stables, which may seem a bit boring, but actually there is an interesting thing to see there. Then I'll continue with the analysis framework of stablecoins, like how we could look at different stables and think if they are okay or not okay, and understand what the risks are. Then I talk a bit more about delta-neutral stablecoins, how they've been created, what's the background, how they work, because it's a big new thing. Actually, it seems, at least in terms of TVL. Then I'll present an alternative approach to how we build this and how some of the concerns may be alleviated. and we'll talk a bit about what's next in this stuff. So, the fact is that in just a year, synthetic dollars, or delta-neutral stablecoins for that matter, went from being almost non-existent, because there was nothing just a year ago, I'd say. I still recall talking to people a year ago on ETH Belgrade, and people saying, why would you build something like this? Nobody does that. So they went from being non-existent to forming a separate category. Now there is a separate category on DeFi Llama, which is called like the basis trade, and there is about 3.5 billion TVL in these instruments. Okay, great. But can these instruments be called stablecoins, for that matter? Or if they can't, what are the risks? Or if they can, what are the risks? So let's take a closer look at it. And the question is, what is a stablecoin? It's a stupid one, right? Everybody knows it. Everybody understands what a stablecoin is, but not quite. The thing is that people still argue about if something is a stablecoin, or it's a synthetic dollar, or it's not a stablecoin, or anything. And when you talk about definitions, actually, since I'm a TradFi guy, I have respect for regulators, and these guys usually know their job when talking about definitions, because that's what they do. So we could just take a look at how regulators globally think about stablecoins, and if something can be called a stablecoin. The fact is that in many jurisdictions there is no such term as a stablecoin at all. Really. There are different terms like e-money, asset reference tokens, electronic payment methods, etc., but not stablecoins. And it turns out that basically, if you take a closer look at it, the thing is that for most regulators out there, at least in the current stage of development, things that can be called digital money are the stablecoins. So those are the assets which are being backed by fiat or liquid or real-world assets. And everything else is not. So for that matter, it doesn't matter if it's Terra, if it's some kind of weird algorithmic stuff, if it's DAI, if it's liquidity, it's not a stablecoin or it's not digital money. So answering the question which I asked is a delta-neutral stablecoin. A delta-neutral stablecoin is the one when you take on-chain asset, for example, Ether, and hedge it from price risks and monetize that. These stablecoins, say like Athena, potentially can be called stablecoins in a regulatory sense of the word. But okay, let's not go into the form over substance and think about what actually is there. And understand that still it's a stablecoin in a broader meaning of sense, what we understand as a stablecoin, and just dig deeper into what are the risks and what are concerns about it. So, what are the factors we should look at when we analyze any stablecoin? And I must say I'm grateful to S&P Global, who provided a brief framework for that. I believe they'll be talking about it a bit later. We took that framework and reworked it a bit to our liking, because that's always fun to do. And there are specific aspects which you should look at when analyzing if the stablecoin is good or stable. There are key factors. First of all, it's asset quality. And this asset quality is affected by credit risk, market risk, custody risk, and other risks, which is a very convenient category to put everything else into place. Then there is additional coverage and liquidation, which is again a key factor, because nothing in this world is perfect, and even the best stablecoin can just easily depeg if it's not being covered by a protection layer. And even if you have the best assets in a stablecoin, if you can sell them off at a decent price, that means that the backend is bad. And the final one, even if you have the best stablecoin in the world, but nobody's gonna buy it, and you can't transfer it, you can't redeem it, that's not a great instrument to have. And then there are additional factors, but these are more matter of fact, like track record, regulatory, operational, third-party dependencies, etc. We don't dive into this because it's not that important. So if we use this approach and take a look at the current stablecoins and typical designs, what are the key risks of those? It's mostly credit, custody, and reserve funds risks for fiat or real-world asset-backed ones. It's market risk, smart contract risk, and liquidation for CDPs or collateralized debt positions like DAI, Curve, Go, Liquidity, etc. And there are a lot of different risks for algorithmic stablecoins. And algorithmic here, I mean non-fiat backed and non-CDP. It doesn't mean that I compare Frax to Terra, for example. Not at all. So let's take a closer look at this final category, right? The delta-neutral stablecoins. So as I stated, it's that a stablecoin being backed by a portfolio which is delta-neutral and doesn't depend on price of the crypto asset. And there are different ways to create that asset, but the fact is that usually, most of the time, people just use perpetual futures. And so when we talk about it, it's interesting to take a look how the perpetual futures started, because it's a massive instrument, right? And it turns out that perps take their start in 1992, when Robert Shiller was thinking about how he can enable derivatives in non-liquid markets. Later, it was developed more by Alexei Bragin, by IceBit, and popularized by BitMEX. And we usually associate perpetual futures with BitMEX, though it's not historically accurate. And then, in 2021, there was the first, I believe, delta-neutral stablecoin. It was built on Solana, and it didn't go too well, but it still laid the foundations. And then the story starts to get personal, and we're getting into the USDC DPEG last March, which fueled the development of next wave of delta-neutral stablecoins out there. And what happens now, just after a year, is that we see a broader range of delta-neutrals being present, and we'll see more and more designs because this thing starts to become larger and larger, being like almost 4 billion in TVL right now. So, having said that, let's take a look into how the basic mechanics look, how they work. What is the delta-neutral stablecoin in itself, which is, again, a new and rather large category. The concept on the surface is pretty simple. It's pretty complicated to implement in the right way, but on the surface it's relatively simple. You take on-chain asset like Ether, you hedge it with a derivative in such a way that this position is delta-neutral, meaning that any price movement of Ether is offset by the price movement of futures, and that means that this is a stable dollar value. So you have a stable dollar value here. Great, what's not to like? But there's more to it, because you can also stake Ether and you can get the staking returns. You can also get cool funding rates from these futures positions, and it's a separate topic, but this stuff is usually pretty good. At least from 5% to 20% to 50%. We've seen 120% one day, just in March. And basically, you have the stable backing, you have returns, and that's the basis for a yield-bearing stablecoin. Great stuff, right? I mean, what's not to like? It's capital efficient. It doesn't rely on actual dollars, on RWAs. It generates good yield. It's cool. The problem is that this part, with the futures, actually introduces quite a bit of risks. Specifically, what are these risks if you take a closer look? Well, I can't say that they're massive, otherwise all these strategies just mean anything, but they can be pretty material, and they have to be managed. So the fact is, first, you trade these futures with exchanges. These can be centralized or decentralized. If they're centralized, there is risk of centralized exchanges present. If it goes down, then you're off. Imagine FTX and you trade futures with an FTX. Not a great case. Market. It's important to note that the delta-neutral design means that the assets do not depend on the movement of the price of Ether. But there is still risk on the funding rates of futures, and they are pretty volatile, and that may destroy your peg, actually. And then again, don't forget that these hedging positions need to be managed. And to do that, you need to run a material operations. And in the case of bank run, this can backfire. Then there's a question of custody. Again, Guy was talking about this in his speech just now. The fact is that custody doesn't help for 100%. There are still residual risks, and the custody itself is a risk in itself. And then there are reserves. Like in such a case, like Spider-Man said that being a stablecoin is a great power and also a great responsibility. You can't let anything bad happen in terms of peg. You can't let the peg be destroyed. So you need reserve to cover any shortfall for these ones. And this reserve should be transparent. And the last one is the other, but it's smart contract risks, and they can be pretty material, especially if you use DEXs instead of CEXs for hedging. Now, what we do to address all these 5 issues here, and we build a different approach to stablecoin designs. We haven't seen it anywhere, I don't think we'll see. What we do, we effectively create a decentralized protection layer, and we create a case where the stablecoin is over-collateralized without reducing the capital efficiency. That means for $1, I can mint $1 of my stablecoin, but it will be overprotected. And how it works is that we take this left part, which is the same, and then we split it in 2 tranches. The senior tranche is the stablecoin, and the junior is the protection layer. And the fact is that the stablecoin is backed by on-chain assets. So we remove the issues with the custody, we remove the issues with trust, transparency, and at the same time, this protection layer, it's scalable, and it's capital efficient, and it's an instrument which provides leveraged yield to users. So, in brief, how this risk absorption mechanics work is that if anything bad happens and any kind of risk materialize, then the loss absorption mechanism just cuts out from the reserves. So we basically handle all these risks. We have a thick layer of reserves, which is much thicker than in any other design. And we also have self-custody for the on-chain assets. But with that out of the way, let's talk a bit about how the space may evolve. And it's an open question. One of it is, why are there so many stablecoins? Do we need those? What's the point? The thing is that they have a product market fit. And that's obvious. I won't even dive into this. But the fact is that different stablecoin designs have different use cases. Fiat-backed ones are great for on-ramping and off-ramping. That's why they're so popular. That's why people use them. That's why people go for them. That's why they have the highest TVL. PDP ones allow to create leveraged crypto positions, and it's great. It's also a take on creating a truly crypto-native backing for the stablecoin, which is a great idea. The delta-neutral ones, at the same time, we view them less as stablecoins per se, more as a base for investment instruments, because they are so great in this regard. And then that means that this space may evolve in such a way that we'll see this space, I mean the delta-neutral designs, the delta-neutral stablecoins, the delta-neutral projects, yada yada. We'll see new setups, working with DEXs, working with CEXs, working with TradFi. We'll see different user segments, risk-averse, less risk-averse. That's what we try to target with our design too. We'll see different chains, we'll see different underlines trying to build the same stuff and extract more yield. And this can be a base, and it will be a base for a line of investment products. And this is potentially huge and massive, because again, as Guy Yan stated, why Athena took off? Because of the yields. People were saying 20, 30, 40% in yields. It's an investment instrument. It's not a transactional stablecoin someone's gonna use to buy bananas. It's not the case. It provides a good layer to access yields which are crypto native, and there is alpha in it, and that's why it's attractive. And the last question, there is a book called Start with Why. I'll finish with why. Why is this needed? Why do we build delta neutral stuff? Why it's cool? Maybe it's just a fun, like strange stuff. The thing is that these products increase market efficiency and they increase adoption. And when we started to build this, we got majority of the TVL from TradFi people who were saying like, I can get 10+% on USD. Wow, that's cool. Please get me in. And I was like onboarding people into crypto from TradFi. And the last point is that while doing this, we'll also uncover new narratives. We'll just develop the market, we'll bring more capital in there, we'll bring more attention, we'll find new ways, we'll create a base for investment instruments, and we'll just drive forward the innovation in the space. And that's always great. With that, if there are any other questions or interest in thinking and learning more about it, get in touch. Otherwise, the main important thing is that I wish you a great day ahead. Thanks for your attention.